What we'll be talking about today is, if you think of it in terms of a classic Venn diagram, is the intersection, and the very tight, fairly small intersection, of geopolitics, global capital markets, and complexity theory, which is a branch of physics. And a lot of people confuse complexity theory with chaos theory. Actually, more people have heard of chaos theory as applied to capital markets. And chaos is a branch of complexity theory, but complexity theory is a little broader, and that's the term I use. And what strikes me about this is that when you go around, I'm sorry, wrong button. There are brilliant people here, I know, in our own U.S. military, where I have a lot of interaction. You meet majors and colonels and three-star generals, and they've got PhDs and they speak 5 languages, and they really are as strong intellectually as people you meet in any walk of life. And then we all know over here, kind of a space most of us inhabit, no shortage of brilliance. And in complexity theory, you just have to visit in the U.S., our national laboratories or any great universities around the world. University of Queensland and Brisbane, I've spent some time up there. You'll meet brilliant people. But the number of people kind of right in here, right in that little intersection, is relatively few. Now, the convergence of geopolitics and capital markets is hard to avoid. Let's just look at Ukraine and Crimea and Russian sanctions. We'll talk about that in a minute. That's growing. The number of people on Wall Street who really have a good grasp of complexity theory, very few. Military people who do it are usually in weapons design, not capital markets. So it's a new field, not very heavily populated at the moment, but I hope as a result of this lecture, we can make the point that kind of nothing is more important in terms of understanding the world, and that's what we're all trying to do. I had the privilege of giving presentations like this on 5 continents, and the number one question I get is, Jim, I've been around, I've been through bull markets and bear markets, up cycles and down cycles, credit cycles, business cycles. I've seen a lot, but I've never seen anything like this. What we're going through right now, I don't understand it. It seems unusual. And my answer to that question is, you're right. It is unusual. We are going through a time that you have to go back at least to the 70s, maybe to the 1930s, maybe even earlier in some ways to understand it. So I think to get that understanding, we need to combine these different fields that I've just mentioned. So let's advance that. I want to talk briefly about financial warfare. I'm going to be spending most of the presentation on currency wars, which are different, but financial warfare is front and center right now. And this is not about wealth maximization. This is not about portfolio management. This is about trying to gain power for a country and damage your rivals and enemies, reduce their power, increase your power in a very classic geopolitical or military sense, using capital markets as weapons. In 2009, I was invited by our Department of Defense. Actually, it was something sponsored by Pacific Command out in Hawaii. They kind of consider themselves on the front lines of financial warfare because they face off against China. But I was invited to help facilitate and design the first ever financial war game. Now, our Department of Defense did not need any help from me in war game design because they do that all the time, but financial war was different. The first rule was that there were no kinetic weapons involved, so you couldn't use anything that would shoot or explode or missiles. It had to be stocks, bonds, currencies, derivatives, commodities, foreign exchange, the instruments you would expect. And I was invited in for the capital markets expertise, and it was quite an enjoyable exercise. I called it playing Risk for adults, if any of you remember the board game Risk, maybe when you were kids. It was something like that, but with a very serious purpose. And we had to design it from the ground up. How long would it be? How many moves would there be? Who would we invite? Who would the teams be, et cetera? And we did that, and then I was able to actually participate in the game, which took place in March 2009 at the Applied Physics Laboratory, which is a top secret weapons laboratory outside of Washington, D.C. We had about 100, a little more people in the room. We had what I call the usual suspects. So certainly for something like this, we're uniformed military, people from the CIA, the Treasury, the Federal Reserve, various government agencies. We had people from think tanks and universities, different scholars. So all of those people kind of are used to seeing each other at these war games, but I was very insistent that the sponsors invite some people from Wall Street, some portfolio managers. I said, look, this is a war. There's going to be a lot of deceit and manipulation and trickery, and how are we going to do that if we don't have people from Wall Street? So So I got a few of my friends in, and we tried to give the Pentagon their money's worth by throwing in a few curveballs. And one of the things we did is we introduced in the moves, and of course we didn't know how it was going to play out. That's the whole point. Try to do something unusual, see how it plays out, and try to learn something in the process. We introduced a scenario. I had a friend on the Russian team. We cooked this up in advance where Russia and China would contribute their gold reserves to a vault in Switzerland and would create a bank in London. And this bank would issue a new currency backed by the gold. We had to use Switzerland and London because we knew nobody would trust the Russians or the Chinese with their gold. But we set it up, good rule of law behind this. But the kicker was the Russians and the Chinese said, from now on, if you want Russian natural resource exports or Chinese manufactured exports, you have to pay us in this new currency. And if you want some of this new currency, you can trade with us and earn it, or you can deposit your gold in Switzerland and our London bank will issue the currency, and then you'll have some too, and we can go from there. Obviously, kind of moving back to a new global reserve currency and something like a gold standard. This was very forward-leaning. It wasn't anything we expected to happen the next day, but again, trying to give the Pentagon their money's worth. It's fair to say that my associates and I were laughed at. We had our friends from Harvard were there, and they said, what's wrong with you? Don't you know that gold is not part of the international monetary system, hasn't been since the 70s. It has no value, it has no role, you're wasting our time. And there's actually, in these war games, you have cells, so the US team might be the blue cell, and the Chinese team might be the red cell and so forth. They have different color teams. And there's something called the white cell. They're the referees. They get to decide if you gained points or lost points after each move. And they initially ruled this move. They said this was an illegal move. I think caught them by surprise a little bit. And we jumped up and protested. We said, what do you mean illegal? It's a war. What's illegal? And they said, they thought about it, they caucused, and they said, okay, it's not an illegal move, it's just a dumb move. But they let us go ahead and play it out. It played out in very interesting ways over the next couple of days. It's all in my first book, Currency Wars. And that was that. I got home after a couple of days, and I said to my wife, well, I have good news and bad news. The good news is my team won. The bad news is I played China. So that was that. But since then, since 2009, Russia has increased its gold reserves 70%. They've gone from 600 tons to over 1,000 tons. China has increased its gold reserves several 100%. No one knows the exact number because they do it in stealth. They lie about their reserves, and they use military intelligence channels to gather the gold in addition to Hong Kong imports. So, but it's reasonable to estimate they have 3,000 or 4,000 tons, perhaps more, but 3,000 to 4,000 tons is a comfortable estimate based on the data we do have. So in fact, Russia and China are going down the path that we laid out for the Pentagon in 2009. They haven't taken that final step, but it's something to watch, and I'll leave it at that. But I think the world is playing out in some ways the way we described for the Pentagon. Moving away from the hypothetical to the real, what's going on in the world today, I mentioned these threats to the US dollar. I'm going to go through three big ones, starting with King Abdullah in Saudi Arabia. Now, I think you're all familiar with what's commonly referred to as the petrodollar deal. The petrodollar deal was something worked out between the House of Saud and Henry Kissinger in the 1970s, the last time the dollar was under threat and came close to losing its reserve currency status. And basically, they said that they agreed to price oil in dollars. And by extension, OPEC would price oil in dollars. There was no reason this had to be true. Oil can be priced in Swiss francs, Japanese yen, Deutschmarks at the time, today euros. It can be priced in gold. It can be priced in a lot of things. It does not have to be priced in dollars. But once it is, then everybody in the world needs dollars because everyone in the world needs oil. So if oil is priced in dollars and you need oil, then you need dollars. This was a very important prop in putting a floor really under the dollar as the global reserve currency. But there was a quid pro quo. The quid pro quo was the United States would guarantee the continuation of the House of Saud and in effect the national security of the Kingdom of Saudi Arabia. That deal worked pretty well. That was the beginning of the age of King Dollar, which we saw throughout the 80s and 90s into the 2000s. But last December, President Obama, in effect, stabbed Saudi Arabia in the back, pulled the rug out from under the deal by signaling, I think it's very explicit today, although I think it was clear last December, that the U.S. is anointing Iran as the regional hegemonic power. What the United States is doing is withdrawing power from around the world. That's very visible. But the president's theory is that we'll leave what we call a cop on the the beat, that in each kind of bad neighborhood around the world, there'll be one regional power, and the U.S. will count on that power to maintain order in its region while we, as I say, kind of withdraw. And our cop on the beat in the Middle East is Iran. So there's a détente going on between the United States and Iran. We're actually seeing elements of U.S. Special Operations Command working side by side with the commander of the Iran Revolutionary Guard Corps fighting the Islamic State in Iraq. If you told me a year ago that's what we'd be seeing, I try to think outside the box, but I would have been a little shocked at General Soleimani and General McRaven cooperating, but that's what they're doing. Now, so Saudi Arabia feels stabbed in the back by this. The U.S. is no longer holding up its end of the deal, if you will. So the Saudis are reconsidering their end of the deal, and obviously they're selling more of their oil to China than anyone else at the moment. So it's clearly just a matter of time before the Chinese and the Saudis work out their own pricing mechanism, which may involve gold or the Chinese yuan or some other unit of exchange. We'll see how that plays out. But that's one important prop. Think of the dollar as resting on a stool with three legs. One of the legs has been pulled out, which is Saudi Arabia. The second leg is our friend Vladimir Putin. We all know what's going on in Crimea and eastern Ukraine. The only reason they're not shooting in Ukraine today is because Putin's getting what he wants. If he were not getting what he wanted, the fighting would continue. Now, Putin has been visible and outspoken about his desire to get off under the dollar and what he calls dollar hegemony, et cetera. No one, left, right, or center, thinks that there'll be U.S. or NATO boots in the ground in Ukraine, or there's going to be any involvement by the West in actually opposing this invasion. But we don't want to be seen to be doing nothing. So the U.S. is responding with economic sanctions, which is a form of financial warfare. That's what it is. I said months ago that these sanctions would be muted, that they would not go very far. And the U.S. is capable of taking sanctions to extreme levels. We did this to Iran. I mentioned we had a détente with Iran in December. That's true. But for 2 years prior to that, 2011, 2012, the U.S. successfully cut Iran out of the global payment system, dollars first, then other currencies by kicking them out of SWIFT, the payment system in Belgium, and putting on embargoes. They were down to, selling oil to Indians for rupee deposits in Indian banks. That was outside the SWIFT payment system. I'm not sure what the Iranians were going to do with all the rupees. I'm not sure how much curry they needed, but that's kind of where they were, doing barter deals, et cetera. A lot of the sanctions were relieved last December, but that was very effective. We had created hyperinflation, bank runs, sky-high interest rates, collapse of the Iranian currency, smuggling was rampant. We were well on the way to regime change in Iran without firing a shot. So our financial weapons are very powerful, and we can apply them to Russia. We could kick Vneshtorgbank, VTB, and Sberbank, the two biggest banks in Russia, out of the payment system, as we did with Iran. Actually, of all the threats that have been put out there, the one that Putin is most concerned about, the one that really hit him where it hurts, we haven't done this, but just talking about it was enough to get a reaction, because the Russians have reserves, they can dump treasuries, they can get dollars, they can do workarounds, they have gold. There are a lot of things they can do to fend off U.S. sanctions, and there are a lot of things they can do to retaliate, but the one that was sort of vital to him is the U.S. threatened to caused MasterCard and Visa to stop payments processing in Russia. Now, when Russia came out of communism beginning in 1991, there was a period of chaos, and they did not organize their own payment system the way the Chinese do. The Chinese have their own credit card system. The Russians don't. They rely on MasterCard and Visa. Now, Putin's popularity right now is close to 90%. President Obama's popularity is 40%, heading south. But nothing would turn that around for Putin faster than Russians going to the store, or the ballet, or the dinner, and finding out that their MasterCards don't work. So Russia is working with China, scrambling very quickly to build a payment system for credit cards, but in the short run, that's a vulnerability. But we're not going to do that, and we're not going to go after Putin's assets. And the reason is because of Russia's ability to retaliate. They can do a lot more than the Iranians. The Iranians are a little bit powerless, but the Russians can only do some of the things I mentioned. They could shut the New York Stock Exchange tomorrow. Let me come back to that in a second, why that's true. But this is a lot like the Cold War, the doctrine of mutual assured destruction, where the U.S. could have wiped out Russia, Soviet Union at the time, with our missiles. They could have wiped us out. That's a very unstable balance of power because the temptation always is to shoot first, wipe out the other guy, and then you win. So this led to development of more missiles. So if the other guy shot at you, you'd have some missiles left so you could shoot back at him. We call this two scorpions in a bottle. One stings the other. The victim's going to die, but has just enough strength left to sting back, and they both die. Kind of gory sounding, but that actually maintained the peace for 40 years. That's a more stable equilibrium, and that's what we have in financial warfare today. So for investors kind of going about their business, working on conventional portfolio allocation models, doing all the things we all do every day, I don't think things of the type I'm describing have been factored in, but these are not remote possibilities. They've actually already happened in some way, and I'll come back to that. And so that's another leg of the stool that's being pulled away. Russia's working as hard as they can to get out from under what they call dollar hegemony. And the third is China, I already mentioned. Acquiring gold by the thousands of tons. Bear in mind, there are only about 35,000 tons of official gold in the world. When I say official, that's the amount held by central banks and sovereign wealth funds, not counting private gold. So for China to acquire 3,000 tons in the past 5 years, which they have, is almost 10% of all the official gold in the world. That's an enormous amount. But that's what they've done, and they're continuing to do that. So there's no reason to do that other than to hedge their dollar exposure, maybe in anticipation of U.S. inflation. So it's a dangerous world. In the military sense, you all know it's a dangerous world in the financial sense, but what I'm suggesting is that those two worlds, combat and finance, have now converged in this area of financial warfare. It's one I specialize in. You're going to be hearing a lot more about, but it's a clear and present danger. It's here today. It's not something that we should be thinking about 5 years from now. A couple, these are cover stories from a couple U.S. magazines. Well, I mean, they're available around the world with the internet, but Bloomberg has the NASDAQ hack. This is an issue at the end of July. It's available on the web, easy to find. And it was revealed that in 2010, the FBI and Department of Homeland Security found a Russian attack bug inside the NASDAQ operating system. So these were not Russian gangsters. These were not people stealing credit card numbers. This was Russian intelligence that had penetrated the NASDAQ operating system. This was described as an attack bug. And the quote I've got here actually comes from someone in our National Security Administration, the NSA, but it says the NSA believed it might be capable of wiping out the entire exchange. Now, that bug was identified, and steps were taken against it, but how many are out there that haven't been found yet? So this is the point I was making about if you escalate against Russia, they can escalate against us, which is why I don't think it will go very far, which is why the Ukrainian problem is not going away. When the president says sanctions are working, what he means is that they're working to do the things the sanctions were intended to do, but they are not working to change Putin's behavior, and they won't work because they can't go too far. If Putin's figured out the workarounds, he's quite the chess player. He's several moves ahead of the United States, and they won't go too far because of this retaliatory capability of the United States. So I'll just leave these articles with you, but you can read them. And, you know, in August 23rd, 2013, the NASDAQ Stock Exchange was closed for half a day. They shut down around lunchtime and didn't open very late in the day. To this day, there's been no explanation offered for that. And I just want to suggest that if there were a good explanation, we would have heard it by now. But if it was some kind of a military attack or malicious attack, there's good reason not to tell people because it would panic investors around the world. So this is the kind of thing going on behind the curtain. As I say, this is not fantasy. This is fact. Okay, I want to segue from financial war to talk about currency wars. I'll go through this quickly because I want to get to some complexity stuff at the end. Currency wars are different from financial wars. Currency wars are actually an economic form of competition as opposed to something malicious. They have currency wars have very destructive economic effects, but they're not, it's not quite military engagement, it's economic policy management. Countries manage their currencies the same way they manage anything else, tax rates, interest rates. No one's surprised when a central bank or a parliament or a Congress move those things around. We shouldn't be surprised that they're doing the same thing in foreign exchange markets. And you don't see currency wars all the time. But when you do see them, they can last for a long time. They can last for 5 or 10 or 15 years. The currency war we're in today began in 2010. And I run into people all the time. They go, boy, Jim, they'll see some headline about Abenomics or Draghi trashing the euro to get some inflation in Europe, and they'll say, gee, how did you know back in 2011 when your book Currency Wars came out that there'd be a currency war in 2014? And I said, the reason I knew is because there was a currency war in 2010. It's the same war. Not surprising. I think I could come back here a year or 2 years from now and we'd still be talking about this subject. So this is not going away. It's like any war. Wars are not continuous fighting all the time. There are very big battles, and then there are periods of quiet, and then other battles. So there are periods of quiet in the currency war, but we have these big battles, one in December 2012 with the launch of Abenomics, one beginning last summer with Draghi's more aggressive approach to cheapening the euro. And so that's what a currency war is. They happen when there's not enough growth to go around. When there's enough growth in the world, the United States can be relaxed. The United States can say, all right, there's some country over here, they're cheapening their currency, they're trying to promote their exports, but we got plenty of growth, and who cares? And you can let that go. But when there's not enough growth to go around, when everyone's fighting over a few crumbs, and that is the condition of the world today, it becomes a lot more serious when somebody tries to cheapen their currency and steal some exports or some growth from somebody else, and there is retaliation. It's like back and forth, quid pro quo devaluations that are the essence of currency wars. There we go. The first one, Currency War I from 1921 to 1936, is a pretty well-known episode. Don't want to spend a lot of time on it, but really started with the German hyperinflation of the Reichsmark in 1922, the Weimar Republic hyperinflation. You've all heard about that, where it got so bad that the currency, you've all heard about 4 trillion Reichsmarks to buy a loaf of bread, and you've seen pictures of people walking around with wheelbarrows of cash to pay for dinner. It's all true, but the middle class was utterly wiped out. But it got to the point where the currency was actually litter and swept down sewers, so it didn't even have a valuation. Interestingly, after that, Germany went first to a mortgage land-backed currency, and then pretty quickly to a gold-backed currency, went back to the gold standard, and was the best performing major economy from 1924 to 1929. So as soon as, so your currency can go to zero. It doesn't mean your economy goes to zero. It just means you have to find a new currency. And the Germans did. It was gold-backed, and they had enormous growth throughout the 1920s. So I think it's important to separate the currency from the economy. That's a big mistake that a lot of analysts made in 2010, 2011. I was very bullish on the euro that whole time. I still am. I know it's down from kind of 140 territory to 130 territory against the U.S. dollar. When the whole world had their hair on fire and was talking about the breakup of the euro and the collapse of the euro, and Greece was quitting, and Spain, Greece was being kicked out, and Spain was quitting, et cetera, Rubini and Krugman and all those voices, I was the one who said, no, the euro is best understood not as an economic project, but as a political project. It's not breaking apart. No one's being kicked out. No one's quitting. Members will be at it, which has been true. Actually, in my book on The Death of Money, page 138, I talk about Scotland joining the euro. The book came out months ago. It was written last year, and that's the buzz today. But that's the trend for more countries to join the euro. But that's because the currency was different from the economy. I knew the economy was in bad shape. I knew the banks were in bad shape. I knew the bonds were in bad shape. But none of that has anything to do with the currency. So I think, I know U.S. analysts tend to mush it all together and say, well, the economy's in trouble, the currency must be in trouble. That's absolutely not true. The problem with a lot of U.S. analysts is they listen to reporters and analysts in London, and they think they're getting news from Europe. The UK hates the euro. They always have. So you get a very distorted view from London. You have to go to Frankfurt and Milan and Rome and Madrid and go on the ground and talk to Europeans to get a good sense of that. So that's Currency War I. Currency War II, of course, Richard Nixon going off gold, period of massive hyperinflation between borderline hyperinflation between 1977 and 1981. The U.S. dollar lost half its value. We had 50% inflation, 50, in that very short 5-year period. So that's something we're on the verge of happening again. So let's not rule that out again. But that was kind of the essence of Currency War II. I already mentioned we're in Currency War III. Started in 2010 and will continue indefinitely as long as the global depression lasts. The Fed has a theory about we'll avoid the mistakes of the 30s by trashing our currencies in unison. Instead of doing it sequentially, the US, UK, Japan, and Europe can all devalue together. In fact, that doesn't work for a number of reasons. What we're seeing, again, are the sequential devaluations. First, the weak U.S. dollar in 2011, 2012. Now a very strong dollar, weak yen, weak euro, which the U.S. is permitting because they're in more trouble than we are. They need the growth. Weak yuan, that's manipulated by China. The U.S. is not too happy about that. But right now, the United States is bearing the full brunt, the full cost of global structural adjustment because of the strong dollar and letting the Europeans and the Japanese weaken their currencies. That will not last. That cannot last because the United States economy is in terrible shape, much worse than most analysts realize. We're going to need the help sooner than later. By the way, the reason people devalue the currency is not to promote exports. Everyone says that. You hear that a lot in Australia. That's not the reason. That's kind of a byproduct. Maybe it helps exports a little bit. The reason you devalue your currency in a currency war is to import inflation. Deflation is the greatest danger around the world today. Central banks cannot have deflation for a number of reasons. So they have to avoid it any way they can. First, they cut rates. They do a lot of things to avoid it. But when you've tried everything else and you're not getting the inflation you want, so we live in a funny world where central banks want inflation and can't get it. But that is the world we're living in. The one thing that usually does work, or can work at least in the short run, is cheapening your currency. And that's the reason for doing it. And that's what I had conversations with staff at the Reserve Bank of Australia a couple of years ago at a time when the Australian dollar was quite strong. And they were trying to cheapen it. There's debate there, and I said, well, first of all, that's a mistake. Australia should really emulate not the United States, but places like Korea, Singapore, Germany, and Europe that have learned to live with and embrace a strong currency. I said, if you want to trash the Australian dollar, you should either expand your government bond offerings and use the money to build critical infrastructure. Don't waste the money on expenditures, but use it to build infrastructure. If the world wants Aussie dollars, give it to them. Give them investable assets by offering 10-year notes at cheap rates and build natural gas pipelines and do other infrastructure projects in Australia. I said, or just print the money and buy gold. That way you can target your exchange rate and keep the gold. Both of those bits of advice were ignored. Instead, Australia went the traditional route of just trying to trash its currency, and they got what I told them they would get, which is inflation. Now they're backing off. So Reserve Bank of Australia is a little schizophrenic when it comes to this. They made the same mistake the Brazilians made, but the Brazilians had to back off, and RBA is kind of backing off, although they still like to have it both ways, but it doesn't work. You cheapen your currency, or you don't get growth. What you get is inflation. And the other problem with the Fed's theory of cheapening together is those are not the only countries in the world. Obviously, we have our friends, the BRICS, and by extension, the G20. They tend to be the losers when the major developed economies are trying to cheapen their currency. They also suffer from hot money inflows and outflows. And so for all those reasons, this policy doesn't work. And I think we're seeing that play out. Already spoke about the Australian dollar. I want to talk briefly about a way of understanding the world today. And I think this is very powerful and something that might be helpful in your own analysis. I call it Fitzgeraldonomics in honor of F. Scott Fitzgerald, one of my favorite authors. But Scott Fitzgerald said in 1936, the test of a first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. I put a lot of emphasis on that last clause. You can't just be muddled. You have to keep these ideas and function. And the two ideas that you need to understand are deflation and inflation are both threats. And too many analyses I hear are binary. And what I mean by binary is you'll hear people saying, oh, you got to worry about inflation. Inflation's right around the corner. They're printing all this money. And others say, no, you got to worry about deflation. You hear Madame Lagarde and others talking about it. And that's the greatest threat in the world today. We need to print money. The truth is we could have either one, right? Because if you knew we were going to have inflation or you knew we were going to have deflation, you would know exactly what to do. You'd construct your portfolios to be robust to either one of those outcomes. But we're on the knife edge. This could tip either way. It's dynamically unstable. So when you see a price series, an inflation index, kind of close to 0, 1%. Don't think of that as price stability. Traditionally, it might have been price stability. Maybe in the 1990s it was. But what it signals is kind of 5% natural deflation coming from the fact that the world's in a depression, and 5% natural inflation coming from policy and money printing. And those two forces are offsetting each other, exactly like tectonic plates pushing against each other in a subterranean fault line. But nobody thinks that that's stable. Nobody thinks the San Andreas Fault in California is stable. We all know that there'll be massive earthquakes. It's just a matter of time. We don't know exactly when, but no one stands on the, I have stood on the San Andreas Fault in a day when nothing was happening. It wasn't moving, but I didn't make the mistake of thinking that it was stable underneath, and neither should you. So you need to be prepared for both these outcomes. Just a brief digression on the D word, depression. I mentioned depression. That shocks a lot of people. They go, oh, what do you mean? We've been in the United States has been in a recovery since 2009. That was the end of the last recession. Look at the data. We're in recovery mode. There's no depression. And I just say, well, you don't know the definition of depression. People think if a recovery is 2 consecutive quarters of declining GDP and a depression is worse than, if a recession is 2 consecutive quarters of declining GDP, a depression must be worse than a recession, so it must be a long period of declining GDP. That's not the definition of a depression. You can have growth in a depression. You can have rising stock markets in a depression. You can have declining unemployment in a depression. What makes a depression is depressed growth, meaning you can have growth, but it's below trend. And in the United States, if our trend growth is 3.5%, and our short-term potential growth is 5.5%, 6%, because we can utilize underused factors such as labor with our low labor force participation, and you're actually growing 1.5%, 2%, that's a depression. The delta between the 2% actual and the 4% potential, let's say, is depressed growth. That's what a depression is. By the way, that's not my definition. That's John Maynard Keynes' definition. I think it's the right one. So we are in a global depression using that. And that difference between actual and potential growth is lost wealth. You never make it up. We are now into the tens and scores of trillions of dollars of lost wealth that will never be seen again. We'll never make it up. The best you can do is get back to trend, maybe. But we're not going to get back to trend because the difference between a depression and a cyclical recovery, all the analysts are used to, these expansions. So you're expanding, things get a little hot, inflation picks up, unemployment gets low, central banks tighten, it goes back down, then inflation cools off, unemployment goes up, output goes down, then it hits the bottom, the Fed loosens, or the central bank loosens, and it goes up again. So you have this nice sine wave of expansion and contraction, which we've seen over and over again since World War II. That's normal. That's not what we're in. What we're in is a depression. And the difference is that depressions are not cyclical, they are structural. And central banks cannot solve structural problems. They can only solve cyclical problems with liquidity solutions. So no central bank can solve the problem, even though they all think they can because they're arrogant, use the wrong models, and they are trying very hard, but it's not going to work. So expect the depression to last indefinitely until you see structural changes. What are structural changes? Structural changes are things like, I'll say in the United States, Obamacare, tax policy, Keystone Pipeline, environmental regulation, a whole list of things standing in the way of entrepreneurship and business. And those are not in the purview of central banks. It's really up to the Congress, the White House, your Parliament, and Prime Minister, and others. So this depression will continue indefinitely. Here's what's happening to money supply. This is why the central banks think they can solve the problem. I have to update the slide continually because the Fed prints money faster than I can update the slide. It's actually a little bit over $4 trillion at this point. But here's the problem. Velocity is collapsing. You go back to this equation, money supply times velocity equals nominal GDP, which has a real and an inflation part that P is the inflation or deflation, Q is the real. Money supply times velocity. Well, the Fed can make money supply, or central bank can make money supply anything they want, and they have, but they cannot control velocity. That's behavioral. And so I'd like to remind people that $4 trillion times zero is zero. In other words, if you don't have velocity or turnover of money, you don't have an economy. And this is the problem. The Fed is trying to get velocity moving with negative interest rates. That's why, again, I said last year, one of the best trades was 10-year Treasury notes. Everyone's like, no, bond market's a bubble, interest rates are at all-time low. Nominal rates are near all-time lows. Real rates are nowhere close to all-time lows. Because, of course, you have to take the nominal rate minus inflation to get the real rate. Real rates are very high. You can have 13% nominal rates and 15% inflation, which we did in 1980. That's a real rate of negative 200 basis points. That's a low interest rate. Nominal interest rates of 13% were lower in real terms than nominal interest rates of 2.5% because of the impact of inflation. And inflation is turning into deflation. So actually real rates are going up. That's one of the reasons the economy is so punk. And so I could see U.S. 10-year Treasury notes going to 100 basis points. I mean, the Japanese have been 50 to 80 basis points for 20 years. So that's what we're seeing in the world today. The Fed has to get 3% inflation in order to get real rates negative, and in order to increase inflationary expectations and get people spending money, you've got to get to 3% inflation. They haven't done it yet. Here are the ways they've done it: cutting interest rates, quantitative easing, communications policy, which I call propaganda, forward guidance and things like that, basically lying to investors about their intentions. Currency wars, Operation Twist, nominal GDP targeting. Maybe we'll get to helicopter money next year. I wouldn't rule that out. Helicopter money is when they just give people money and cut out the banking system, cut out the middleman. We'll see what happens. I'm really looking for QE4 next year under Yellen's Fed. The only reason the Fed is going to finish the taper, that's baked in the pie. But right now, we have a very hawkish FOMC, one of the most hawkish ever. We have Charles Plosser from Philadelphia, and Richard Fisher from Dallas. There have been a lot of vacancies. Our FOMC is a mix of Fed governors and regional reserve bank presidents. It's supposed to be 11 members, 7 to 4, weighted in favor of the governors, who are traditionally dovish, but there have been anywhere between 2 and 4 vacancies at various times. So the governors show up, it's more like 4 and 4 with 3 vacancies. So they're kind of outnumbered, and then you got 2 super hawks among the presidents, Fisher and Plosser, and Yellen's the new kid on the block. She doesn't want to tear up Bernanke's policy. So she's been stuck in this tapering. They will finish by October, but the U.S. economy is extremely weak. Watch what happens early next year. Now in January, there's turnover. So Fisher and Plosser come off the FOMC, and you're getting 3 super doves. Charles Evans of Federal Reserve Bank of Chicago has told me privately that he wants 3.5% inflation. Dennis Lockhart of Atlanta, and Coach Lakota of Minneapolis, who has been outspoken about the fact that the Fed is blundering by tapering, which by their lights, I know, using their models, that would be the correct conclusion. So don't be surprised if you see QE4. Everyone saying, gee, when is the Fed going to raise interest rates, March or June? Going back to our first question, will rates normalize at 7.5%? I was looking for the bracket that said 10 to 20 years, but you do have 7.5% plus. That would have been my vote, but we may never see normal interest rates in my lifetime, because without structural changes, because there's really no way out of this liquidity trap, not by cutting rates anyway. So that's kind of a background on what the Fed's trying to do, what policy is. I don't have very much time to tell you what could possibly go wrong, but the Fed model would look at that car and say there's nothing wrong with that car. It's shiny, it's got a full tank of gas, brand new tires, the engine's running fine, absolutely nothing wrong with the car. But if you use complexity theory and dynamic modeling, you would say, no, that car's going to fall down, crash, explode, kill a bunch of people. It's the difference between dynamic analysis and equilibrium analysis or static analysis. If you have the wrong models, you'll get the wrong results every time. I don't have time, unfortunately, to go in depth to complexity theory, which would explain exactly why the Fed models are wrong, but I'll just spend a minute on this slide. This is one of my favorites. This was put together by our friends at State Street, but it's an index of equity market stress, and I would just point out the following. If you look at where we are now and ask yourself, what does that resemble? What does that most closely resemble in the last 35 years? Well, it most closely resembles this. And then we see what happens. So get ready for the heart attack. The best indicator of high volatility is extended low volatility, which is what we're in. There are a bunch of other indicators that show the same thing. This one just shows that you can explain all the stock market performance by money printing. It's a striking correlation. And just talk a little bit about the collapse of this system. There are 4 outcomes here. One is multiple reserve currencies, which is unstable in its own way because there's no anchor. One is SDRs. Most people say, what's an SDR? Good question. SDR stands for special drawing right. Really easy way to understand it. Special drawing right, the Federal Reserve has a printing press, they can print dollars. The Reserve Bank of Australia has a printing press, they can print Australian dollars. European Central Bank has a printing press, they can print euros. Well, the IMF has a printing press, they can print SDRs. SDRs is not what in Philadelphia we call walking around money. You won't have them in your pockets, but they are money. And in the next liquidity crisis, when the next liquidity crisis comes, and it will be soon, And if you don't think so, just go back over the last 30 years and see how they appear every 4 or 5 years like clockwork. But when it comes, it's going to be bigger than the central banks. Last time, the Federal Reserve, forget about the $4 trillion on their balance sheet, they did tens of trillions of dollars of swap agreements with the ECB so the ECB could get dollars to bail out the European banking system. They guaranteed every bank deposit in the United States. They guaranteed every money market fund in the United States. Most of that support has not been withdrawn. So they've used up all their dry powder. When the next crisis comes, what is the Fed going to do? Take the balance sheet from $4 trillion to $8 trillion, $12 trillion? They're at the outer limit of confidence. There's not, all the other central banks have done the same thing. There's not one clean balance sheet left in the world except for the IMF. The IMF is only leveraged about 3 to 1. So you'll see trillions of SDRs printed and handed out among the major countries, and then the IMF actually has a trading desk inside the IMF where countries that get the SDRs, for example, Hungary will get some SDRs. They don't need them. They need Swiss francs. So they'll swap SDRs to China for dollars, sell the dollar spot, get Swiss francs, and pay off their Swiss franc debt. So there's a whole secondary market. You won't see it. It's behind the scenes. But this is how we will re-liquefy the world. That will be extremely inflationary in all the major countries. A minute on the gold standard. I'm not predicting a gold standard. There's no central bank in the world that wants it, because they like the power to print money and control economies, but they may have to go to a gold standard, not because they want it, but because they have no choice. There's no other way to restore confidence. If they do, it's one of the reasons I've been bullish on the euro. The United States has 8,000 tons, but if you take the 18 members of the European monetary system, the Eurozone rather, who back the euro, collectively they have 10,000 tons. Australia is a funny case. Australia is one of the major gold producers in the world. You all know that. But Australia as a country has a pitifully small amount of gold reserves. So Australia is going to have to hitch a ride on the U.S. dollar when the showdown comes. China, of course, is lying. I'm showing them officially at 1,000, but they're up here. They're up here somewhere around 4,000. They're going to keep going, I think, till they surpass the United States. And you can see some of the other countries I mentioned. The elements of a gold standard, you have to decide a couple things. You have to decide, because every gold standard is a relationship of money to gold, and it's pretty simple. Well, what's your definition of money? Is it M0, M1, M2? You have to decide that because they're all very different. And how much backing do you need? The gold bugs say, well, it's got to be 100% or nothing. That's not true either. Historically, the United States and the US had very successful gold standards with between 20 and 40% backing at various times. So here what I'm showing, and this is 8th grade math, there's nothing secret or fancy about this. If you take, I'm using US ECB in China, if you take that global M1 money supply with 40% backing, gold needs to be $7,000 an ounce in order to have a non-deflationary gold standard. You can price gold at $1,300 an ounce, which the market's doing today. But if you went back to that, the amount of gold available, you'd have to shrink the money supply to hit the parity, which was the mistake that was made by England in the 1920s, extremely deflationary. I dare say that mistake will not be made again. So the question is, what is the implied non-deflationary price of gold in this new system? And the answer is with 40% backing, it's $7,000. If you use global M2 with 100% backing, that's $44,000. Don't tell people Jim Rickards predicted $44,000 gold. I'm not. I think the first case is more likely, but these are the numbers. You can see where gold has to go if confidence in paper money is destroyed, which it may well be. I think the most likely outcome is actually collapse, social unrest, and neo-fascism, and militarized police, and then, I hope you have your gold by then because you won't be able to get it.